Yeah, I've started. Thank you, Patrick. So, as I was saying, financiers and investors do not change, no matter when the crisis changes, because their core business, just the same way your business is to sell products and services or deliver products and services, their core business is to generate and create, to invest and get returns. Okay, so in many cases they will still be very active. Although as that happens, there are also more opportunities that come in terms of others who want to just support businesses that are coming up with solutions that are actually solving the current day-to-day gaps and challenges. So in such circumstances and in such times, you will always find that there are actually more opportunities than normal, simply because the situation is not normal. So as business people and as entrepreneurs, your key insight, your key analysis on how you can solve, how you can create value is very critical as you pursue your business. Why? The moment you have something that is of value, you actually attract opportunities in terms of investment opportunities and also other opportunities that exist within. So that is something that I thought would be worth sharing for you. I will start with this to just set a few things clear. And I remember last week I mentioned about the aspect of you can own your business or you can have partners in your business. At the end of the day, your assets, okay, the value of your business will always be equal to what you have borrowed and what you've put in. That will not change. So, and that is why you'll find the bigger you are, the more valuable you are considered to be. People will not look at how much you've borrowed so much. Okay, it may be a factor, but your value will continue rising. And that is why the thought of being significant in terms of extending your ability and value to wider audience, to a wider market, makes you extremely valuable. And that is what the biggest companies in the world are doing. All they're doing is, yes, a few people put in resources, but they reached out to get more resources to ensure that they can extend their products and services globally. And because of that, their worth or their assets or their value is considered very high compared to any other person who probably the owners have input and does not have probably external liabilities or loans, but yes, is delivering value. The only difference is it will be limited to his ability, while these other companies, it will not necessarily be limited because he has opened doors and is actually serving more. And as he serves more, he's obviously generating more, and his worth will certainly be more than one who is struggling on his own. And that is, and this equation is a very powerful equation. For those who have studied Italy, there is a place called Venice. I was lucky to be there. There has to be a story of merchants of Venice, traders of Venice. This is an equation where traders actually realize that anything you have is either from you or from what you've borrowed, and that will never change. So it's a very powerful, simple equation that guides the thought as when you figure out as an entrepreneur. And for those who understand, I'll just mention a bit about the balance sheet. It's made up of assets is equals to liabilities plus orders equity. What I just want you to understand from this is your worth today is equivalent to what you put in, whether in terms of thought, ideas, or brain, plus what came externally, okay? And that will never change. Last week, we focused on our business plans, and the reason was a goal without a plan is a wish. So it was very important for us to think through our plans so that we create a goal. And from that goal, we can make sensible decisions in terms of where we are trying to go as a business. And as you plan, obviously, you also need to make an important financial plan. And we did some financials last week in a very simplistic way. Yes, there are various ways in which, and I'm happy to share with you deeper how we can present financials, but with consideration of our current level, I thought it wise to use a very simplistic approach and use unit economics to just help you articulate your business very well. Everybody will appreciate if you say, you know what, my bottle of water, I spend 500 to make, to have a finished bottle of water, and I sell it in the market at 800. Everybody will appreciate something of that sort. So you can simplify or you can make it complex, but at the end of the day, it's the understanding of the person you're trying to reach out to. And the more simpler, the better. This is also a recap of last week. When you have a good idea, when you have refined a model that has great potential, your next aim is to ensure that you have capital to expand as fast, okay? To grow systematically, but very fast strategically, so that as you grow, you're actually taking on the market. But at the same time, you are preventing any other person who could want to do what you do from coming into your market. Why? You will have reached out and created relations so that by the time somebody wants to come in, he has to invest a huge amount of money to actually eliminate you from the market. And that is why people who exist in the market and you come with a product close to what they are doing, you will find you have to invest a lot in terms of time, or you maybe have to save to sell cheaper, but in the same way, probably you will incur cost. And usually that is what we call barriers to entry. When you get into the market and you get your territory, by the time somebody else comes to try and penetrate your territory, you are fairly in a firm foot. You have the resources. You can in some time, and that's why some big companies sometimes when they see a competitor who may eliminate them or have a better idea, all they do is they buy him. They can invest in that business so that it becomes theirs. Haven't you seen Coca-Cola invest in Dasani, which is a water? They realize that people are the water business is going to, and they invested in Dasani. That is Coca-Cola's water company. They realize that people's tastes are also changing. They want to now enjoy some juice and fruit juice. They invested over 25 million to Minute Maid, $25 million on the Minute Maid. I understand one of their production facilities is in Kenya of Minute Maid. And you'll notice that that's what companies do. But they are big enough and they have the capacity to buy off, or they have the capacity to partner with you. So the advantage of growing fast is you have the ability, you become an equal. You're able to see opportunities that are available and you're able to embrace them. But that gives you an advantage only when you are big enough. But when you remain small, then it becomes a challenge because you'll be struggling first of all to feed yourself and to pay the staff. So you may not even have the competent team, and as such you will find your struggles are more internal, intrinsic, than dealing with external opportunities or challenges. And you'll find even in the Bible they say, to whom much is given, much is expected, and for those ones who have more, they will be added more. So when you reach out and get more, you will find you are attracting more opportunities. If the president is looking for the biggest companies to give them discounts or tax havens, it is you, because you are big. If you are small, they say, you have to pay tax. And that is why you'll find sometimes business people ask, why is it that you are giving investors, these Chinese, you are giving them free land? You are giving them tax holiday for 10 years. And for me, who has been here, you are charging me. That is the precept. That is the concept behind. The bigger you are, the more opportunities you attract. But the less, you literally have no voice because you are not as significant. So as businesses, we should strive to grow and become significant, because the more we become significant, the more voice we have, but also the more opportunities we attract. and at the same time, the stronger barriers to entry. And barriers mean somebody who is going to do something similar to what you do will certainly struggle to actually get into the market. Why? You've established a strong relationship with the existing market, and that is a very big advantage for any business. As we think of raising money, there are a few things obviously we need to know, and one is we need to understand financial instruments. Financial instruments are, I mentioned briefly last week, but we shall go deeper a bit today. So financial instruments, the major ones are debt and equity. That is loan and equity, which is giving out shares of your business. Okay, and it is also important for us to know, okay, which institutions are out there. As we plan to pitch first, there are a number of institutions. Sorry, I don't know. Your background is a bit noisy. Thank you. When you are trying to raise money, you need to know financial instruments. There is debt, which is equivalent to a loan, and equity, which is giving stake of your business, or selling a piece of your cake, or sharing a piece of your cake, of the business cake, if I'm to put it that way. I'm sure you've heard politicians say they want to also eat part of the cake. But in business, equity is sharing a cake of the business, or sharing a piece of the business. Then which financial institutions exist that you can access or raise money? We have angels. Angels are people who have made money. Either they are people who have big jobs, maybe these top CEOs, they don't have time, but they would want to invest. They may not have time to do business, but they may want to invest in ideas that are essential. While some are people like you, if you've grown your business to a level where you've attracted investors and now you are worth a lot of money, then that money becomes available for you to actually go now and start looking for other business you can invest. Now there you become an angel. Why do we call them angels? Angels are fairly understandable investors. They may find you with a lot of gaps, but they will focus on the opportunities that you create. So angels investors will not pay a lot of strict attentions in some of the gaps that you may have. They will probably evaluate and see if it is something that they are passionate about, or a cause that you stand for and they're very passionate, then they may want to invest in you. So we may have some angels next week who will be paying or listening to you people. Banks are fairly strict because it is a financial institution. One, it has to comply with Bank of Uganda, but it also has regulations to limit risk. So you'll always find with banks, they have specific prerequisites or requirements for you to qualify. Okay, then we have venture capital. Venture capital, they play a role beyond the banks. You may be doing very well as a business, but you may not necessarily have the prerequisites. But at the same time, you have a great opportunity. But at the same time, you notice banks give more of debt, actually largely debt, unless it's an investment bank. So venture capital play a role so much in equity, though quite a number of them here in Uganda also give debt. Then equity funds purely focus on equity. Then we have some accelerator programs that come once in a while, which you'll find entrepreneurs benefit, maybe 5,000, 10,000, or whatever. These are programs that come once in a while. We have existing accelerator programs that are going to fund, and we hope that we shall also share those opportunities. So there is High Innovator of NSSF, which we shall share with you. And then there is, what is the other? We shall also share with you that, so that you can benefit from such opportunities. Then there are a number of financial tools that usually investors or financiers look at. One is the income statement. The income statement, some of you call it profit and loss account. So profit and loss simply evaluates the performance of your business and evaluates if you're making profit or loss. Last week, what we were doing was close to an income statement, but very simplified. so that you can articulate both your performance and basically profit. So we sort of try to simplify an income statement, and in the same time try to bring out what a cash flow statement will look like. But if we go formally and so deep, you'll find an income statement basically presents the performance of a business. Balance sheet brings out the financial position, the status of the business in terms of assets, liabilities. I think I showed you the equation. So the balance sheet basically shows what is the status of the business in terms of what it has in terms of assets vis-a-vis liabilities. Cash flow statements simply shows what is in and out in terms of cash. It shows the financial flow, the cash flow, the physical cash, liquidity of the business. And then the business plan, which we worked on last week, it shows where you're trying to go and what you are short-term, or what are your immediate plans moving forward. And then valuation analysis, I think I mentioned 3 core methods that we use to evaluate. And I mentioned about the cost approach, where we evaluate the replacement cost of an asset. So if you have land, we look at, okay, if it was to be replaced, or if you were to buy similar, what will be the value? So if you have a vehicle and you want to buy another, we should just look at replacement value. So it's basically largely focuses on ideally assets that you can actually value and look at the replacement cost. Then there's the income approach, and some call it the discount cash flow analysis. So income approach simply looks at how your current and future cash flows, okay? And then it assesses what is the value of that cash now. If you are going to make money 3 years, what is the value of that money now? And then using that, it is computed in a way that it gives a value of the business as it is today. And that is what an investor will probably invest in based on what has come out. So there are some formulas. I just didn't want this to be a complicated thing. Then the third one is the market approach, where we look at an equivalent ratio in the market of a similar product or service that you are doing, and then we multiply with the current profit of your business. And I think I just mentioned that to simplify that, you can value your business in terms of looking at the profit and multiply by 5. And that gives you a fair assessment of the value of the business, assuming it is at that point where it is generating revenue. But when it is not, then the valuation approach becomes a bit different. All right. So I just mentioned about these key statements. The income statement reports the measure, the performance. The balance sheet shows the status, while the cash flow shows the inflows and outflows of business. Okay, financing options. So when we look at financing options, we have dilutive and non-dilutive capital. Dilutive means you are diluting ownership. So if Roy owns 100%, when you come in, you are diluting my ownership. That means you are reducing my ownership. While non-dilutive does not necessarily reduce ownership, okay? So you'll find, for example, core dilutive will be like equity, because equity dilutes ownership, while non-dilutive can be debt. So you'll always find those ones that go on dilutive tend to take the shape of equity, and those ones that are non-dilutive take the shape of debt or loan. All right, now on this one, you'll find we're going to start, and here we're just going to discuss quite a number, and some of these terms are just important for you to know. So non-dilutive, and I'm going to try and explain a bit. So on non-dilutive, you'll find, I'll give you an example of I don't know if any of you have heard of Islamic banking. So, for example, in Islamic banking, it is Sharia law that they are not supposed to charge interest So when they give you money, it will take either the shape of equity, or it will be either profit sharing or revenue sharing. Okay. However, we do not have many players doing that here in Uganda using this model, but the few partners that we have, unfortunately, really have a high ticket size. I think the existing partner we have who provides this kind of support starts from about $5 million. So unless you are in that category where you can absorb that money, usually we don't see it relevant for us to waste their time. But when you reach there and you are interested in this kind of model or shape of maybe revenue, profit, or equity, like in an Islamic format, then this would be a good one for you to pay attention to. Then we have grants and donations. I think grants are very common from the NGO world. Most of them write grant proposals and send out to donors, and the donors fund them to deliver either a certain project or program. Okay, so does that happen in business? There are some grant opportunities that appear that focus on businesses that are either doing something. For example, Joy is doing something on nutrition, and maybe an organization or a donor is looking at improving the nutrition of the community. They may actually fund maybe Joy's business to ensure that she produces more of her nutritious flour and distributes to the community. Okay, and in some cases, some may simply donate for you to deliver. I think a good example is last year when we were in the COVID crisis, there was this company called Aponye. Aponye is one of the large scale producers, maize and bean producers, I mean, either distributors or something. So Aponye was given a contract by the government to actually deliver beans, though something happened midway. But I would put that close to something close to, okay, that is a supply order. I was trying to bring an example of a donation. Yes, last year we saw quite a number of people donate either products, properties, whatever was required, vehicles, to the government. So if government was a business, then it would that would be considered a non-dilutive opportunity. I think I've mentioned about revenue or profit sharing. Then we have some opportunities called recoverable grant. So recoverable grant is where either a donor or an organization gives you money to do whatever you need to do. And when the project goes well and you generate money, you pay it back just as it is, you don't add. Okay, and if things don't go well, we forget, they won't disturb. That happens. There are those who have done that in a number of different scenarios. We've also had a scenario where we've supported, I think, actually 3 entrepreneurs who got non-reimbursable grant, which is more of, they give you a grant for you to deliver on a project or a program, and yeah, if it aligns with your impact. And I think one of those was actually doing something similar to what Joy does. Debt is non-dilutive because you always pay it back. Mezzanine is also non-dilutive. When things go well, you pay back. When things go badly, we convert that money into ownership. So that is mezzanine. I think we had, there was a fund called Yield Fund here in Uganda. I think they ended their cycle last year but one. They were providing this kind of support, mezzanine, where they would give you as a loan, but if things become tight or the season becomes tight, they convert that money into equity so that it gives you ample time to actually do business. Okay. And then dilutive, I mentioned, I don't know if I did, but convertible note. Convertible note is where maybe an investor is very interested in your business, but during that period, probably you urgently need the money, but you also need to negotiate the right kind of conditions to ensure that it is a win-win partnership. So sometimes within 6 to 12 months, they can decide to give you initial deposit or money, and this becomes a convertible note, where they say, we shall convert this money we have given you into equity, maybe in 12 months. For now, maybe there are some milestones. However, in some cases, if things do not turn out right, then it may actually become non-dilutive, where you pay back. It converts into a loan. It's almost close to mezzanine. Actually, in some cases, we call it either convertible equity or convertible debt, but it's a convertible note. And then equity is where you give percentage ownership of your venture or your business. Okay. Many entrepreneurs on early stage, or those ones who are starting, usually are very emotional on equity, because they feel they have invested their time, they have invested their ideas, and somebody out there just comes and says, now you know, with this I need this percentage. Many usually become emotional. It's emotional, but in some cases also review it logically and assess, if I get these resources, what can we be able to achieve, and what happens to the organization? Are we able to have the right competent team that will give us better results? Will it give me more opportunity to actually grow? And as I grow, maybe I create barriers to entry. Maybe I serve more, and the more I serve, obviously, the more I generate, and the more bigger I grow. So those are decisions that you'll find yourself making as time goes. I think so I'm going to focus a little bit more on debt and equity. So debt is almost equivalent to borrowing money. A lender will pay back in the future to invest, and while in equity, you are taking capital from an investor in exchange of ownership of your business. Okay. But for you to consider either debt or equity, we look at your business model. Okay. One thing you will realize is investors do not invest in anything. Most investors have a certain focus. They will say, for me, maybe a focus on agriculture, IT, and so you'll find you may not go, you may have a very good business, but if it is not in the sector of a particular investor, he may not necessarily be interested, not because you are not an interesting business, but just because you do not focus in his core focus of interest. Okay, so sometimes you'll find entrepreneurs knocking door on any. Actually, with investors, they look at the industry. Are you in their industry of interest? Because they all have different interests. There are those who are interested in creative arts and media. There are those who are interested in agriculture. Actually, in the country, we have so many who are interested in agriculture and agro-processing. Okay, then we have those who are interested in ICT, fintech, digital. There are those who are interested in manufacturing. Okay, so your business model and industry will be key for them. They will business model, for example, there are some financials who look at your gaps in working capital and may see, okay, with this one I can work because his model falls within my category. So your business model and industry matters. Your financial need, okay, so you may need a certain amount of money, which is not within the scope. Okay, so many times you'll find there are those who prefer starting from $50,000 and above, which is equivalent to about 180 million and above. Okay, some may be looking at 100 million, $100,000 and above, which is equivalent to around 350 million and above. While some are looking at maybe 100 million and below. So they also look at the need. Just by the financial need, they can say, this one is not in my category. And you'll find the more you actually do your business, you'll realize more investors prefer giving more, not less. Simply because the more they give, it is easier for them to manage. They would rather give few more money than give many less money, because their cost of managing you become a portfolio to them. So the cost of managing and supporting you becomes very high if they give many less than giving few more. Okay, so the financial need also is a factor. And then the business stage. Are you starting? Are you in the growth phase where customers need your product and you now need to shoot? Okay, so based on the stage that you are, you'll also attract a different financial partner. Okay, so just to summarize on debt and equity, you'll find in debt, if you get a loan, nobody will influence you as the leader of your business. You will still remain the way you are, and you'll be the final decision maker because the loan you took and you're simply managing your business. But when you get equity, it means you've got a new partner. Okay. And so you cannot just make decisions alone. You cannot just wake up and say, now we are going east, then tomorrow we are going west. No. For you to decide east, you probably have to justify now to your partners, why should we go east? Okay. We've discovered a new product and we need to put it. Why should we proceed with this product? So sometimes, and you'll find now as an entrepreneur, it becomes more of you need to justify. You just don't wake up with an emotional decision and say, now we are going east. Why are we going east? So you'll find when you go into equity, it will be more of justifying. Why should we go this way? Why should we go that way? That's why the choice of your equity partner and the terms that you engage, they should share your vision so that as you go through that vision, obviously there are some strategies you'll take. They will always help you align towards your goal. But remember, on strategic decisions, they are always involved. Then repayment in debt, obviously, in debt, you are told, you always say, 1 year, 2 years, 3 years, 4 years, repayment. In equity, there is no due date, okay? Because it's not about paying. You've got a partner and you'll share the opportunities that emerge. Yearly obligations, maybe in debt, you'll be paying interest, in some cases even monthly, while in equity, there is no liability for you to pay dividends. Or there's no liability for you to pay, okay? And then tax benefits, if you've taken debt, now this is an advantage for those ones who will understand. When you take debt or a loan is deducted, your interests are deducted, okay? Okay, I mean tax benefits. The interests are tax deductible. So in other words, before you remove tax, okay? Before you remove tax from the business, you'll always find these financial expenses, okay? Now, some companies like this, okay? I don't know if some of you read the newspapers a bit. You'll find they used to say Trump does not pay tax or pays very little tax. You'd find they would ask, why is this billionaire not paying tax? You'll actually find by virtue of rules of accounting, you usually remove the financial cost before you remove the tax. So because of that, you'll find it reduces their cost of paying. So sometimes having a loan is good in a business, as long as you know how to manage it, because you have to remove it before you go to URA to say you are paying tax A or B. Okay, so you'll find some businesses deliberately, even if they're making money, they always have a loan. Okay, but you have to be very smart about it. With equity, dividends are not tax deductible. So in other words, with the dividends, it's out of net profit. So there you'll have already removed the tax. What do investors look for? Investors look for management. Have you ever heard of the word of the saying, people do not buy the product, people buy people? I don't know if you've ever heard that saying. This is where management comes in. Okay, you may meet somebody who is selling a very good product, but the way he speaks, you may actually not want even to hear him. Okay, and there is somebody who may come with a product. It looks weird, but the way he talks, you feel like this product you need to buy. At one point, we had, we were sharing with my team, one of my colleagues sold, I hope you can be able to get the insight, sold pads a man. So by the time a lady convinces a man to buy pads, then she must have convinced, because now men do not necessarily use, but probably unless he was to buy for somebody. But it's not something that you'll find men necessarily buying. So management is people buy people. How does somebody go and convince you? Have you ever had somebody say that person can convince you to buy a sweater during the summer or during a hot weather? Okay, so that means this person is very is a salesperson and can be able to make you do even something that you may not necessarily want to do. So on management, we look at, are these people passionate? Are these people, can we trust them? When they say they want to go to the moon, should we trust that they are going to the moon? There's a company owned by one of these richest billionaires called, I'm forgetting his name. He's the owner of now Tesla. He used to be in South Africa, then went to US. I'm forgetting the name. So he has a company that wants to go to Mars. Is it him or this British one? And people have even paid in advance transport to actually go to Mars. Okay, now that means people have really trusted him that he will ensure that the goal of reaching to Mars exists. So that tells you, as you are struggling to attract investors to buy something that is realistic, some people are investing in something that probably may not necessarily be, but they just trust this person that based on what he has so far done, he will take us to Mars, a planet which some people are just interested to go and visit. Okay, so you'll find in the technology world that is something that is happening, and I think some have even had their ships. There are 2 or 3 that have that goal. Then market. Do you have market? Do you have people who want your product or service? And is this market growing? It's not just about having the market here, but do we have the potential to expand this market so wide? And that's why I kept on telling you, the bigger the people you serve, the more significant the value of the business. Why? Because the more people you serve, the more value you actually create and the more opportunities you attract. So the bigger the market, the better. Okay, so is this market stagnant or it is growing? Then the money. Based on your performance, your income statement, performance, do we have evidence that you've actually been generating? Have you been banking, or the money comes from this pocket in the left and from the right it disappears? We have no evidence. At least maybe keep money on mobile phone so that you can trade. So money, do we have evidence that this money, this story of the money exists when we look at the documentation? Then momentum. What strategies do you have in place to ensure that this thing is moving fast? What are the strategies that you have in place? So just as I mentioned in management, we look at 70% the people. That's why you'll find somebody has a very obvious normal idea, but investors would rather invest in him than somebody who has a very unique idea but is not trustworthy. Why? The person behind the business is more important than just the business. People invest in people. Okay, because these characters, this passion, this enthusiasm is very important in the process, because these people are likely to make the goal or objective succeed. So are you a bankable person? Can somebody trust and entrust in that vision that you are setting out, that I can actually take this company where it needs to go? The markets. Okay, now in the market here we look at the size. Now, for example, some of you may be in East, but based on the people you are targeting, eventually, maybe in 3 years, you can look at, now we shall go countrywide. Okay, so based on the market that you've defined, does it grow? Okay, when you say I'm in East, how deep are you? So that when we, so that when you expand, we know that this company has potential. Then products and services. What problem are you solving? Okay, you have to be solving something that a customer needs. Remember, any business solves a problem, need, or gap that somebody pays for. So what are you solving? Are you enabling people access education, quality education, or holistic education? Are you enabling people access nutrition affordably? Are you enabling people access tasty food in a healthy way? Okay, what is your cost of production vis-a-vis the pricing? Is this pricing manageable in terms of enabling you to be sustainable, profitable, or you are selling on a loss? Okay, and what is your promotion strategy? Are you reaching out? Have you found ways in which you're actually reaching out to this market? The market is a very important decision factor when it comes to investors. And you'll find, by the way, and this happens a lot in startups that are technology. You'll find that the person has started and in no time he has 500 users, he has this. Immediately when they see that within 1 month he had 500 users and whatever potential customers, they may even say this company is worth $2 million and he has not even started generating money. We call that pre-seed, but it's because they have seen the potential of the market. That is why I showed you the example where WhatsApp had over 500,000 users and Facebook paid 22 billion. It paid 19, but currently it's about 22 billion value. Yet the company was actually on a loss. Okay, so the market, they look at what is that. By the way, the market is extremely powerful in a business because the companies will value, because they can influence the market, they can do, they can bring new products in that market if you already have. So the market is usually a very important factor. Money, okay, you are how your business has been performing, money coming in, money going out. Do you have these statements? We did something simple and I would keep it that way for now, okay? But as you grow, you will get to know some of these deep aspects. For purposes of preparing for PitchFest, we don't want to make it complicated because from the simplistic perspective, it's still business. All right, on the momentum, we look at growth potential. Your business model. I think I was sharing a little bit about Olivia's business. At this point, she's looking at the school, the physical, but probably she can have a model, a unique product. Maybe I've packaged, this is a holistic study, whether with COVID lockdown or not, as long as you spare 2 hours every day or 3 days or the weekends, we can have them benefit from accelerated Christian learning. And out of no, it can actually be blended or packaged in schools, and you find, okay, that becomes a product on its own, and an investor can invest in that, okay? So the growth potential, sometimes we look at what is the potential of this business to grow? What have you created barriers, or you are just selling to a few and you're not thinking of penetrating the market so that people are consuming your products and are appreciating so that they cannot go for an alternative, okay? Then business continuity, what is the demand? Okay, now if you want to expand, for example, for Patrick, sunflower oil, will we sustain the supply of this sunflower oil, sunflowers from the farmers, or how are we going, how are we collaborating with maybe producer cooperatives, giving them contracts to actually farm more or something like that? The aspect of demand and supply is very important, and how innovative are you navigating through your journey? And risk, competition, these are factors that are looked at when we're looking at when investors are evaluating your business. All right. Now, as a business, remember when you're engaging externally, there's a lot of documentation. You'll not just tell us something and we assume, okay, what you've said is what it is. There are a number of key documentation that you may need to have. You may have some, you may have all, but these are some of the documentations that as an entrepreneur, you need to start paying attention to. You may not necessarily have some of them now, but it's good to start thinking about having such documentation. So if you've registered, you need to have a certificate of incorporation or a registration certificate. That is very important. If you're obviously doing business, it's good to have the business or trading license. Okay, that one is given by the local council. If you are a company, then you have a memorandum or articles of association. If you're not a registered company, then you always have a registration slip or something. Since you are a person or you are people doing certain business, you have to be authenticated as authentic human beings. So what authenticates you as a person is either your ID or your passport as a director, so that when we say Olivia is Olivia, you have evidence that Olivia is Olivia. You cannot tell us you're Olivia and the passport says you are Genevieve. Okay, so we need to ensure that you have documentation that validates that you are who you say you are. Then PIN, or some of you call TIN. So this that depends on the level. If you are a taxpayer, but usually it's recommended you start recognizing or registering yourself for tax. We shall want to know the compliance of the directors. Are they complying with the tax authority, or are they registered, or is the business registered, and then do they file returns? Returns are these payments you pay or you file, or this is reporting to URA that, oh, I made a profit, I didn't make a profit. We do it periodically. Actually, we are in the month of June, and the official financial year has ended. Depending on, some companies do January to December, some do June, 1st July to 30th June, but the government follows 1st July to 30th June. So, and that's when you find budgets are always read in June. So during this period, are you filing? Okay. And I must say, this depends also on the level. Okay. But you'll notice as you open up doors of your company, an investor always also wants his money to be compliant with the systems. So if you've not, then they will necessitate and they will initiate such processes so that it is compliant. If you have a product that has to be certified by UNBS, okay, and you've not, then you need, in your presentation, you need to say you've not, but you're in the process, or if you have, then you need to indicate, because as you consider expanding, it cannot expand without fulfilling the requirements of the various authorities, okay? Tax compliance certificate, usually you'll find, even when, for you to get a government contract, they will usually ask you either submit a tax registration or tax compliance to show that you're actually a compliant business. Okay, if your business is over a year, you need to start thinking of having an audited financial statement. This is usually done by competent registered or certified accounting firms who come and help you put your books in order and give you, okay, in year one, this is how you performed. Officially, they are independent, and they will give you an independent review, but they will also advise how you can improve some of your systems. Then, but one thing you should not miss is a certified bank statement from banks, at least six months. Many ask for 6 months or 1 year to show that your bank is active, okay, that you actually deposit. So some of you who do business on open air, where it comes and goes, I just need you to understand that endeavor, if you can, to ensure that when somebody pays you, you can actually deposit in the bank and withdraw at the same time. I don't know, but I can tell you that I've done that several times, where probably you need the money and you need to use, you go and deposit. You can even deposit and withdraw more, okay? But it is important that that money is indicated in your statement that you've deposited. Why? When you start creating that behavior, it presents accountability. Though at the same time, nowadays, now we have even phone systems, what should I say, phone applications or fintechs, where somebody can pay you on phone and it can even generate a report. That is also an option. If you honestly cannot deal with the bank, but people can pay you through certain platforms. There are quite a number. For those who are interested, I'm happy to share that on a different note, where people can pay you and it will keep a track, okay? So when you need a report, it can actually generate for you a report, and that is evidence, because evidence of money in and out and accountability and behavior of money is very important to investors when they are coming to engage, because they want to see who are we dealing with. Then for some of you who have orders, supply orders, LPO, local purchase orders, work contracts, agreements are very important. So if you are supplying, say, Patrick, you supply to another wholesaler, maybe 50 boxes every month, this is the time where you say, you know what, you sign here that I'll be supplying 50 or whatever, because you can, that document is very valuable to investors because it shows that you actually, so if you have maybe hotels, you have schools, or you have, it's always good not to have, oh, you supply, okay, I'm supplying tomorrow. If you can have, if they cannot give you that from their side, then you can generate something where I say, okay, I order 40 boxes, sign for this month or for the next 6 months, something like that. It can change, but the fact that you have this, those pieces of paper are worth a lot of money, and you'll come to realize that some of the financials we are working with are very interested in that to give working capital, because people who are dealing with supply orders, LPOs, work contracts need more of working capital to actually solve their problems. Okay. Then financial projections, I think that's what we did also last week, where we are looking at based on your numbers, okay? Based on your numbers, where are you going by the third year, by the 5th year, okay? The financial projections become important, because an investor is also able to assess, if I'm giving you, say, a loan, will the business be in a position to pay? Or if it is equity I'm coming in, is it valuable? Is it worth my time to put in money with these people that eventually we're going to achieve or grow? Because for equity investors, usually they are looking at the growth, because when you increase in value, they can sell part of their shares and recover, or another investor may come in and pay them off. So for them, they are very happy. Or you can even buy them off, but you'll buy them off at probably 3 or 4 times, which is fine if you've grown to that level anyway. So it's always very important to see, okay, based on your plans, what are the projections? How do the numbers look like? Is it attractive? So these are common documents that we need to know. Does somebody have a question on this? All right.
Sir.
Yes, please.
Yes, good morning.
Good morning.
Now, where you talked about the LPOs, eh?
Mm-hmm.
Yeah, the LPOs, the local purchase orders.
Mm.
Now here, most of my LPOs, I have them as personal, like before, not as a company. Can that one work?
No, it is fine, but you will need to indicate deliberately that as much as they are personal, they deposit the money to the bank. You see, the order can come to get root, but
Yes.
does this money go to? But eventually, you need to highlight that you're actually going to push or focus front the business. Why? Because you don't want, they want a level of transparency. So the business needs to exist as an independent entity. So if they come to get root, but the money will go to the company account, then that would be a good start. But eventually, the orders need to come to the business, okay, for purposes of ensuring, because we cannot mix Gertrude's money and the business money. We need to separate for purposes of ensuring that if somebody wants to come as a partner, we can easily manage that account, okay? So that your money is separate. If you need to be paid, you can pay yourself maybe a salary. That is free.
Yes.
Okay, thank you. Any other question?
Mine is that you find some business they may even be having a company account, but because of other challenges in using one of the director's accounts, what happened to that situation?
That's a very good question. So, Patrick, I'm going to use this as an example. Okay.
Yeah.
I'm going to use this as an example. Put yourself on the shoes of an investor who wants to invest in Patrick's sunflower oil. Okay. And wants to see, Patrick says we make 10 million. And he says, okay, you share with me these documents. Now you are not Patrick, you are now the investor. And he says, oh, 4 million is going to the account, 6 million is going to Patrick. What will you think as the investor?
That the money is going to Patrick.
Patrick, I want you to tell me, not from the entrepreneur, from an investor's shoes. What will you do? What will you think?
Roy.
Yes, sir.
I put that question because we're going to have the pitch fest on 1st July.
Yes.
Now, some of us have those challenges. What do we do? Do we keep off from the event as we correct? Do we have to wait for next year? What do we do?
So first of all, no, I wanted you to understand first from what will this person think. So you need to highlight that you have seen the potential of the business and the business is now independently going to exist on its own. So since maybe June or since July, okay, previously you've been banking as Patrick or whatever, but now the money is going directly to Patrick's account. It is understandable from an investor's point that it takes some time for a business to become independent from the people. Okay, and that is why you'll find usually when you are starting and an investor comes, because you are not seeing the difference between you and the business, it becomes very emotional for you to say, I'm giving 40%, because you'll always think that it is you. But you actually realize that the business is independent and you can both benefit by working together. Then now at that point, you start appreciating that now, since the business is independent, it's not Patrick. So we need to get a very important or a very good salesperson who we can pay well, but will deliver. Then we need to get, so there you will now start looking at it independently. It's the same way a mother who has a baby, when you give birth now, you will always want to hold the baby. You don't want anybody else to play, usually initially. But over time now, the child starts growing. She has to go and play with the others, which at the end, they will even have to move out of the house, okay? They will even move out of the house. So that is almost the way the business works, okay? Initially, it's within. And we understand in some cases, it was even Patrick doing as Patrick. Are we together? But now then Patrick needs to start releasing the business. Okay, you now need to give birth to the business and give life to the business. Giving life to the business means ensuring that money goes to the business and you control and manage what the business does. Are we on the same page? So we understand that you may have come from there, but it needs to be deliberate that where you are going is to ensure that this business can stand on its own. Okay? Patrick, have I answered you?
I think that is perfectly understood.
Yes?
It is perfectly understood.
All right. So there's nothing wrong with hearing, initially and that's, you'll hear so many stories. I started with the 20,000. 20,000 did not start the business. 20,000 probably started selling posho like that. Then after starting the posho like that, then it became a product. Then the product became a business. Then the business was registered. Are we together? So you are not the first and you will not be the last, but it should be deliberate that you actually now want to see the business stand independently. And that will be very important. Right? Okay. So this is typically how the process of investment works. So some of you, I just need you to be aware, because sometimes we don't understand, where am I? How is this related? Where have we started? So in investment, you can look at startup as where Pitch Fest is. Okay. So when we conduct the Pitch Fest, or when we do Pitch Fest, we are showcasing you to investors. Okay. Now, when an investor shows interest, they will start the screening. They'll say, "Oh, Patrick, I like this business. I think there's great potential." So they'll say, "Okay, Patrick, share with me the following." So you remember we were working on the plan. Chances are the plan will be requested for, depending on which finance or financial it is. And then, okay, share with me maybe your financials or whatever. The other thing I wanted to answer, Patrick, if the client was paying to your account, then there is evidence that in your bank statement that the clients paid. So you can battle your bank statement, but then you need to show that now the client A is now paying to the company or the business account. So that can also help. So initial screening is where we evaluate such kinds. One, how the business is doing, how the documentation is, and usually some support. So you may find in the initial screening, you may still need some support, and we are available to support. Then they do due diligence. Due diligence is just evaluating and understanding. Now, this also depends on the kind of money that you are going. Now, this is typical, especially for equity, because equity usually takes longer, because here you are getting more of a marriage partner, a business partner. So they have to do the ins and outs, get to know who Patrick is, how does Patrick behave, what does the community maybe think about that business or Patrick as him. Then they look at the clients, they may even interface with the clients and say, "Hey, what do you think? How is the relationship? What is the quality?" Even if they can't, they even get an insight of the consumers. Why? They are trying to see, is this something we can go with to the future? Is this the future of the new cooking in Uganda or whatever? So they will look at various things, okay? Because remember, they're looking at going all in. You know, when they come in, they're in for it, okay? It's not coming in and moving a step back. When somebody's in, it is in, okay? It's the same way when you make a vow in the church, it means you are in. Some say for sickness and health. So it is like you are in for it, okay? So in the same way, the investor will look, I am in, I'm going to invest my money, so I need to get to know this people, okay? Then after they will do valuation or assess, okay, the value of this business based on the assets and how the business has been performing. I think the value is at 100 million, 200. So then we come to the table and say, okay, the business from our side, I think we can give you 80 million at 20%. And there you start negotiating and say, "Oh, but you see, can you see this? Can you see this? Or can you validate?" And usually that is something that is can be negotiated. And then when approval comes, they sign what we call a term sheet. You as the entrepreneur, you sign a term sheet. It has the terms of engagement. Okay, so in that term sheet, it will specify percentage of the business, what. And then still after that, if it is an equity partner, then you may also need to change the shareholding in the business officially in URSB and other things. And then obviously in terms of decision making, you will have to create a board, or if you have already one, you may need to adjust the membership of the board and the decision-making process. And then obviously if they are incompetent staff during due diligence, they can even tell you, you know what, your financial person is not competent. We shall get another. That means they are fired, that one. Why? They want competence, but they want to ensure that the business can achieve its potential. So sometimes you'll find some difficult decisions happening where even somebody you worked with who was very committed, who was very trustworthy, they may find the person is not competent or does not qualify for the position they are. And when the company grows to another level, it requires a set of competence. So sometimes you may negotiate and have this person maybe take another position, but usually it's out of principle that they want a structure that is formidable to take the company to another level. Okay, so usually that is sort of how the process goes, especially for equity. For debt, once they see, this one has collateral, has this, or at least based on the numbers that we are seeing and the customers and the LPOs, we give you money, they will give you. But for equity, it takes a bit. And usually you'll find on average, equity will take about, on the lower side, about 3 months to actualize, because it will be back and forth. On the higher side, it may take even as much as a year to actually formalize. And that is why sometimes we have convertible note. If the money required is urgent, they may say, okay, let's give you this as we do our work, but we feel like we are in, but because we need this to proceed, start with this, and then once we complete the process, then we can, something like that. So that is on, especially on equity. Now, there's something entrepreneurs always say, that when you sell or when you give part of your company, there are a few things you can do, because any investor, most investors for that matter, they do not invest forever. Some of you may